In this video, I'm going to be talking about trading options in smaller options trading accounts. And when I say smaller options trading accounts, typically I'm going to be referring to an account with $2,500 to $5,000 in the account. Keep in mind that you'll need at least $2,000 at any brokerage firm to open a margin account. And if you don't have a margin account, you're going to be severely limited with the option strategies that you can trade in the first place. And since we are limited in a small options trading account as it is, it's going to be even more difficult without a margin account. So I would recommend having at least $2,000 in a margin account so that you can have full access to options trading privileges. I trade with Tastyworks, and with a $2,000 deposit, you can apply for a margin account with full options trading privileges. But at other brokerage firms, you may have tiered access, meaning that depending on the tier of privileges that you have, you'll have access to a small basket of option strategies. And once you unlock the next tier, you'll unlock more option strategies. And finally, with the highest tier, you'll have the ability to trade basically any option strategy that you want, so long as you have the appropriate amount of money in your account to cover the margin requirement. Trading options in a small trading account is very difficult because since you have a limited amount of money, it's very difficult to trade a small portion of your account since you can only really get so small with the option strategies that you're trading. For example, if you have $2,500 in a margin account, if you put on a position with $500 of loss potential, that represents 20% of your account in risk, and obviously that's a very large position given that you could potentially lose 20% of your account if that trade were to realize the maximum loss potential of $500. Unfortunately, it's very difficult to risk just 5 to 10% of a small options trading account, because if you do have, let's say, $2,500 in an account and you wanted to risk 5% of that options trading account, that would be risking $125. To be honest, entering an option strategy with just $125 of risk is going to be very difficult because you're going to have to trade very low price stocks, and or you're going to have to trade option spreads with very narrow spreads, and in that case the maximum profit potential is going to be very, very low, and in most cases the commissions required to enter those positions is going to eat into a decent chunk of your maximum profit potential. We all want that home run trade that can earn us a significant amount of money or earn us a significant return on our total account in a very short period of time. And I think that urge is even stronger in a small options trading account, because you're thinking if you could just have one big win, then you'll have much more money to work with and everything will be easier. But unfortunately, it's not that easy. Before getting to the small account option strategies and back tests and my other tips and tricks, I need to talk about the difficulties of trading in a small options trading account so that when we move forward, we can understand these difficulties and try to figure out ways to work with them. The first problem with trading in a small options trading account is the risk problem. As I mentioned earlier, when you're trading options, you can only really get so small, and when you have a small options trading account, that means you're going to be risking a high percentage of your account in every trade, or at least you're going to be tying up a significant amount of margin in one position, because with a small options trading account, if you put on a trade with only $200 or $300 of risk, that could represent a high percentage of your account. The first thing that you need to be comfortable with when trading in a small options trading account is putting on a position that is going to require a significant amount of margin requirement relative to your account size. Now, because your maximum loss potential is equal to 10 or 20% of your small options trading account, it doesn't necessarily mean that you're going to be risking that amount, because in this video I'm going to recommend that you manage trades before expiration. And when you're strict with your trade management and you do not hold trades until expiration, the likelihood of realizing the maximum loss potential on any trade is very low. So in the worst case scenarios, I would say that you are not actually going to be losing the amount of your max loss potential in a trade that goes against you. The second problem I need to talk about before getting to the small account options trading strategies is the number of positions that you can trade in a small trading account. Now, as we've already discussed, if you have a $5,000 account and you're putting on a position with $500 in margin, that is going to represent a maximum loss of 10% of your account in the worst case scenario. Now, a lot of people will think that it's better to trade more positions in an options trading account because with more positions, you are technically diversified, but in my opinion, you are not. And if you are adding more positions to your portfolio, more than likely they are going to be correlated, especially if you're putting on, say, 2 different iron condors in 2 different stocks. And if the market plummets, more than likely you're going to lose a lot of money on both of those trades. So trading 2 positions is not actually helping you in this case. It's just actually increasing your risk overall and in your portfolio. And in a small options trading account, I would not recommend trading more than 2 positions at a time. And for the most part, I would say it would be best to start with just 1 position at a time, because if you are trading in a small options trading account, it's likely that you are a beginner, and by focusing on just 1 options trading strategy, you can focus on watching that particular position and learning about options by watching that particular position's changes on a day-to-day basis. Moving on to topic number 3 is trade management. As I mentioned briefly before, if you're putting on a trade that represents a loss potential of 10 to 20% of your small options trading account, you need to have a system in place where you know exactly when you are going to exit that trade for a profit and for a loss. Now, the loss management is far more important than knowing when you are going to close a trade for a profit. So when you're trading in a small options trading account, before you even put on a trade, you need to know exactly when you're going to exit the trade for a profit and when you are going to exit it for a loss. Before getting to the strategies that you can potentially employ in a small options trading account, let's talk about the products you are going to trade. In my opinion, the safer stocks and products to trade when you're trading in a small options trading account would be to stick with broad stock market ETFs such as SPY or IWM, or even QQQ, which is the NASDAQ 100 ETF. I know it is enticing to trade penny stocks with a smaller options trading account because the options are cheaper, and therefore you will have more access to different options trading strategies on those penny stocks. But you have to keep in mind that when you are trading options, you are trading outlooks on a company's stock price. And because of that, I would not trade any obscure stocks. I would stick to broad stock market ETFs or very well-known stocks such as Apple or potentially even something like Netflix if you have a higher risk tolerance. Let's go ahead and hop over to the Tastyworks trading platform and also the OptionNet Explorer options trading analysis software so that I can show you potential trade setups that you can use in small options trading accounts. I can show you the difference between margin and risk when using the same exact option strategy but on 2 different products that have different stock prices. And also, I'm going to simulate and backtest some of these strategies to show you how we can expect the trade to perform and how they can potentially be managed before expiration to avoid any blowout trades. I hope those explanations helped and you are more comfortable with how you can potentially set up and execute a trade in a small options trading account, and that you understand how those positions could work out based on the passage of time, changes in implied volatility, and changes in the stock price. Right now we are looking at the Tastyworks trading platform, and specifically I have the option chain open for SPY, which is the S&P 500 ETF. I love SPY because it has a lot of liquidity, and as we can see here, today SPY traded 113 million shares, and if I go ahead and open up an option chain, we can see how much activity is actually in the options as well. So if we look at the open interest columns for the call options and the put options, we can see that the call options have thousands and thousands of open interest, and the same for the put options as well. The specific strategy that I'm going to start with is called the short iron butterfly, and I like this strategy because it is a directionally neutral strategy and it has limited loss potential. So I have an entire video dedicated to the iron butterfly strategy, which I will link in the description below. But just to recap, an iron butterfly strategy is when you sell the at the money straddle and then you buy a put option below the strike price and then buy another call option above the strike price. So another way to interpret it is selling a call spread and selling a put spread with the same exact short strike. So SPY closed today at 333.48. So that means we can pretty much choose the 333 or the 334 strike price as the short strike for this position. So I'm going to go ahead and use the 333 strike, and to queue up an order to sell it, I'm going to click on the bid for the 333 call, and then I'm going to click on the bid for the 333 put, and then to complete this iron butterfly position, I need to purchase another option above the market or above this strike price, and then purchase a put option at a strike price lower than 333. So what I'm going to do is actually purchase the call option with a delta near 15. I'm going to do that for demonstrational purposes, and there's no real specific reason I'm doing that, but it is a methodical way you can use to choose strike prices for any strategy that you're using. So I can already see that the 344 call option has a delta of 0.14, and that is the closest strike to the delta of 0.15. So I'm going to click on the asking price for the 344 call, and then I'm going to do the same thing on the put side. So right away I can see the 314 put has a delta of 0.15, so I click on the asking price for the 314 put. Now we can see that I have a short iron butterfly position, and the current credit is $9.09. Now this means for one iron butterfly, the maximum profit potential will be $909, and the maximum loss potential in this case is $991, which would give us a buying power effect or margin requirement of just about $1,000 for this position. So if you were trading a $2,500 account, this is a limited risk strategy that you could put on, but obviously this is a lot of risk relative to $2,500. One of the things that you could do to reduce this would be to trade an iron butterfly with narrower strike prices, particularly the options that you're buying. So I could move this in 2 points to the 342 call, and then I could move up the put to the 316 put as opposed to the 314 put, and now this has a margin requirement of $865 as opposed to $1,000. But as I move the strike prices that I'm purchasing closer to the short straddle, I will actually collect less of a credit, and therefore my maximum profit will also decrease. If you need to decrease the risk, one way you could do that is by moving the strike prices closer to the short straddle. So before going ahead and actually visualizing this position and doing a simple back test, I want to look at this exact same trade structure but on IWM. So I'm going to go ahead and clear this trade. I'm going to switch over to IWM, and IWM is the Russell 2000 ETF. So I'm going to open up the March 2020 options, and those have 28 days to go. And really quickly, I'm going to do the same exact thing as I did before. So I'm going to sell the at the money straddle and buy the 15 delta call option and put option. So IWM was at 167.10 when it closed. So I'm going to click on the bid price of both the put and the call at the 167 strike, and that queues up the short straddle. And then I'm going to click on the asking price for the 174 call, because I can see that the delta of 0.14, and that is closer to 0.15 than the 0.19 and 0.11 delta call options that are available at the adjacent strike prices. So I'm going to go to the put side and do the same thing, and right away I can see the 157 put has a delta of 0.15, so I'm going to click on the asking price for the 157 put. So this is the same exact trade structure that I queued up in SPY, but since IWM is half the price of SPY, I'm expecting that this position will be smaller altogether. So we can see that the credit is $4.95, and we can see that the maximum loss potential is $505, giving us a buying power effect or margin requirement of $505. So this is the same exact trade structure as I just queued up in SPY, but since IWM is a much lower price stock, I can put this same exact position on, but it is essentially going to have half the size as the one in SPY, because SPY is twice as large. Now I will mention that IWM and SPY will not move the same, because IWM is the small cap index, whereas SPY is the S&P 500 large cap index, and they do not have the same exact movements, but they are both highly active products with great option markets. So for this example, I'm just showing you that if you have two different price stocks, you can set up the similar trade structure and it will be cheaper and require less margin requirement in the lower priced underlying. So now that I've gone through this trade structure, let's go to Option Net Explorer and then actually do some simple back tests so that we can understand what this position looks like in terms of the payoff graph, and then also do a simple back test to see a profitable and unprofitable scenario. I've opened up Option Net Explorer, which is options trading analysis software, and I can use this to back test certain strategies and also model different trade adjustments to see exactly how it will change my expected profit and loss curves. And it's cool because I can look at the expected loss curves at different intervals in time in the future. And I'll show you what I mean by that. So right now I have January 15th, 2020 opened up about 30 minutes before the market closes. And we can see that the last price for IWM was 166.53. So I'm going to queue up the exact same trade structure that I looked at on Tastyworks, and that means I'll be looking at a short iron butterfly. And to start that position, we know that the at-the-money strike price is 166 or 167, since IWM is at 166.53. So for this example, I'll use the 167 strike price to start off our short straddle. So the way I'll model this trade, first of all, I'm looking at the 37-day option cycle, which has a little bit more than a month to go. And to start this off, I will model selling one of the 167 calls by typing -1 into this model box. And then I'll do the same thing for the 167 put. So I've gone to the 167 put, I type -1 in the model box. And on the right-hand side here, we can see it updating with all of the modeled trades that I enter. So currently I have a short straddle queued up. And to finish this off, I need to purchase the call option with the delta closest to 15. So that's the 173 call in this example. And I'm going to type +1 into the model box to simulate buying one of these contracts. And then I'm going to do the same thing on the put side by going to the 158 put, typing +1. And now I have a modeled trade of this iron butterfly structure that I was telling you about on Tastyworks. So to actually commit this simulated trade and therefore execute it and see how it performs going forward, I can click commit trade up here, and this will bring up a window with the price. And let's say I sold this for $4.21 or $4.20, I'm sorry. I hit save, and this trade is now committed. So on the bottom left, I can see the cost of the trade and the margin requirement, as well as the Greeks and the P&L information as I go forward. So we can see that the delta is pretty close to 0, and we can also visualize that by looking at this curve right here. So right here, the curve is relatively flat, and that is a visual representation of a delta that is close to 0. As we go further to the left, and as the stock price falls, we can see that the delta will get positive, because if the stock price fell to 164, then an increase would help the P&L and a decrease would lead to more losses. On the other side, if IWM went to 170, we can see that at this point in the graph, the P&L gets better if the stock price falls, and the P&L gets worse as the stock price increases, which is representative of negative delta. So now that I've had this position queued up, we can go ahead and look at intervals in the future to see how the trade is expected to perform. So this curve right here is actually the profit and loss expectation of this position for IWM stock price changes today. So if we move forward in time to this next curve, this curve is actually T plus 12. So this T plus 12 means today plus 12 days. So these are the expected profits and losses for this position in 12 days if IWM is at these specific prices. This next curve up is T plus 24. So in 24 days time, if IWM is right here and there are no changes in implied volatility, this is the expected profit and loss curve for this position in 24 days at various IWM prices. To simulate the trade's performance going forward, I can click on this next trading day button up here, and we're going to jump forward in time and see what happens and talk about this position as time passes. So the first day, IWM gapped higher. I'm going to continue clicking through. We can see that IWM is still in this profitability area, but it is not yet profitable. So at this point, IWM has fallen to $160. Now, if you look at the profitability range, we can see that the break-evens are around 171 and 163. So IWM needs to be within this range for this position to be profitable at expiration. But I like this example because we can see what happens when the stock price falls significantly. So when I put the trade on, IWM was around 167, and now at this point in time, IWM is at $160. So this position is not doing well, but fortunately, we can see that the loss is only $115, which represents 25% of the maximum loss potential of around $500. So we can see the maximum loss down here is just less than $500. And because the loss right here is only $115, it is still not a bad loss relative to what it could be. Earlier when I mentioned closing trades before expiration to avoid the worst case scenario, this is exactly what I meant. If I was uncomfortable with this position at this point in time, which I probably would be if I was holding it, I would probably close this position and take the loss of $115, because at this point, if IWM stayed right here and at expiration was still at this price, the loss would be more than double that at around $270, which I can see right here on the chart. As long as you manage a position before expiration, you will not realize the maximum loss potential, and this is a perfect example of an opportunity that you might have to close the position, take your small loss, and then potentially redo this position and reset your strike price to the current price. So I'm going to go ahead and keep clicking forward so we can see what happens with this trade. So things are going better, and now it is back at the short strike. So this is February 6th, 2020, and these options have 15 days left until they expire. As we can see here, IWM is right near the short strike of 167, and currently the trade is up $80, which is a 16% return on the $484 margin requirement for this position. So let's see what happens as I continue to go forward. So now we're a couple days ahead, and now these options have only 10 days left until expiration, and the position is now up $115, or almost 25% of the margin requirement of $484. So as we can see here, these lines are very, very sloped. And what this means is essentially it's a visual representation of gamma risk, or the increased sensitivity of an option position as you get closer and closer to expiration. So basically what I mean by that is we can see a small change in IWM stock price will drastically change the expected profitability of this position. If I click 1 day forward or 2 days forward, we'll notice that these lines get even steeper on each side. So we can see that these lines are even steeper, but fortunately IWM is still within this profitability range, and at this point in time the trade is up $130, or 27% of the margin requirement of $484. So at this point, depending on how I'm managing this trade, I would likely have a profit target and I would have had a loss limit, but I would probably take this trade off because these options only have 8 days left to go until expiration. And as we can see here, these expected P&L curve lines are getting very steep on either side, and that means if IWM has one big movement day, this position could easily go from a nice profit to a decent loss, and I do not want to let that happen. So in this instance, I probably would close this trade. The last thing I want to do is talk about things you should never do when trading a small options trading account. The first thing you should never do when trading a small options trading account is selling naked options. Selling naked options means you are selling a call option or selling a put option without any protection against the movements against those positions. So for example, if you're selling a call option and that's the only trade that you're doing, you have theoretically unlimited upside loss potential. And if you are selling a put option without any protection below that put option in the form of another put option that you've purchased, then you are going to have significant loss potential on the downside. Now, the reason I would not recommend selling naked options in a small options trading account is, first of all, you are probably going to run into margin issues because selling naked options requires a significant amount of margin because the loss potential is so great. Now, another reason that selling naked options is a problem, and the bigger reason it's a problem, is because you have theoretically unlimited loss potential, particularly in the case of selling a naked call option. But when you're selling a naked put option, you have significant loss potential to the downside, and if you're selling a call option, you have theoretically unlimited loss potential to the upside. So that means all it takes is one bad move against you, and your small options trading account could turn into a $0 options trading account with just one bad trade. So I would recommend sticking to limited risk strategies such as trading credit spreads or debit spreads, or combining credit spreads into something like an iron condor or a short iron butterfly. All of those trades have limited loss potential. The second thing I would never do in a small options trading account is trade too many positions. As I mentioned earlier, doesn't matter how many positions you trade. If the stock market moves big in either direction, it's very likely that your positions are going to become one larger position. And what I mean by that is, for example, if you sold 4 different iron condors in 4 different stocks and the market drops 5% in a week, it's very likely that all 4 of your iron condor positions are going to be losing trades, and they could potentially be very big losing trades. And if you have 4 of those trades on at the same time, not only is it going to be difficult to manage and exit 4 different positions, but you could potentially experience a huge loss relative to your overall account. So if you had a $5,000 trading account and you put on 4 different iron condors with $500 in risk, your overall margin requirement for those 4 iron condors would be $2,000. And that means your maximum loss potential, should all 4 of those iron condors not work out, is also going to be $2,000. And that represents a 40% loss on your overall $5,000 account. If you're in a small options trading account, I would stick to focusing on one position at a time. The third thing to never do in a small options trading account, and I touched on this earlier, is trading obscure penny stocks. Because penny stocks are very low price stocks, their options are also going to be cheap, and that's going to allow you to have more flexibility in the strategies that you can trade in a small options trading account. But since you are trading a company when you are trading options, and since your option position is going to make or lose money depending on what that stock price does, I would not recommend trading obscure penny stocks, and I would recommend sticking to broad stock market index ETFs such as SPY, IWM, or QQQ. So that's going to do it for this video. If you have any questions, please leave me a question down below in the comment section, and I will get back to you as soon as I can. My name is Chris from Project Option, and I will see you in the next video.